I always have the pleasure coming your way, and I'm excited that today our focus will be on tax planning. In the layman's language or word, what is tax planning? Well, it's something kind of a way of ensuring that savings on taxes, like it ensures savings on taxes while simultaneously conforming to the legal obligations and requirements of the Income Tax Act 1961. The primary concept of tax planning is to save money and to mitigate one's tax burden. I hope you get it. Do you get it? Well, let's see. What is planning? When you are planning is deciding in advance what to do, how to do it, when to do it, and who to do it. Well, so today I take you through tax planning. Perhaps an example of tax planning will be claiming deduction for payments like home loan premiums. That will help in tax planning by reducing overall tax outgo. Every taxable person wants to escape from paying taxes. Perhaps you need to drop a comment. Let's know your mind or view on this. Taxes, which encourages them to use various means to avoid tax payments. Tax avoidance and tax evasion are two techniques which are used by most taxpayers to reduce their liability. They do so by taking expert advice. Tax avoidance is completely lawful, while tax evasion is considered as a crime in the whole world. In spite of many differences in the two practices, people use them interchangeably, which is incorrect. Strictly incorrect. So, we will help ourselves to know the significant differences between tax avoidance, which we said is legal, and tax evasion, which is illegal. It's a crime. It's a crime to evade tax. Well, we want to try to explain the concept of tax avoidance and tax evasion. Well, to also state the differences between tax avoidance and tax evasion. Moreover, to identify the effects of tax evasion on the economy and to explain the approaches used in availing a business to tax incentives. Let's start. What is tax evasion? Tax evasion involves the intentional disregard of the legislation in order to escape the liability to tax. Tax evasion may be achieved by understating income. So your income is small, but you want to reduce it. Then by overstating expenses, making false claims for allowances, or failing to disclose chargeability to tax. Undeclared income probably counts for the bulk of evaded taxes in Ghana and is referred to as the black economy, where individuals work for cash in hand without declaring the income for tax purposes. So instead of declaring the income, you would rather prefer that a person pays you cash so that you go on evading tax. As loyal citizens, we should not do that. Tax evasion is a criminal activity for which the taxable person is subject to punishment under the law. Acts that constitute tax evasion includes hiding relevant documents, not maintaining complete records of all transactions, making false statements, deliberate misrepresentation of material facts, hiding interest in offshore accounts. Some possible effects of evading taxes on the government includes Cost of developing systems to combat tax evasion. Yes, because they need to stop or curtail tax evasion. They need to develop systems for that, and all these are cost to the government. It also results in increased costs of hiring experts to combat the tax evasion. Then government will have to borrow more money for projects. Governments could spend less on infrastructure and the provision of basic public needs. Now let's see what tax avoidance is. A tax such as VAT or VAT can be avoided simply by not buying the taxed good or service. In this respect, it can be seen to be a form of tax avoidance. The arrangements of an individual are first so as to mitigate the liability to tax is tax avoidance. So here you do everything in your capacity to avoid the tax. If it's VAT is slashed on goods and services, we all know our respective countries, the goods that attract VAT. Hitherto, if you don't buy that good, it means lawfully you will avoid paying the VAT that is paid on that good. And provided that the taxpayer acts within the framework of the law, tax avoidance is legal. However, where the activity is within the letter of the law, but outside the spirit of the law, the distinction between avoidance and evasion may become very, very blurred. Ways of tax avoidance are merely tax planning opportunities that exist in the legislation for reducing the liability to tax, e.g., choosing the most tax-efficient savings and investments, or making sure that all available reliefs are used to their full advantage. However, loopholes in the legislation also create opportunities for tax avoidance. However, once a loophole has been exploited, the Revenue Authority reacts by introducing legislation to close that particular loophole. The process of using legitimate means to reduce taxes is described as tax avoidance. So here you use only legal means to swerve the payment of taxes. A tax such as VAT or VAT, the value added tax, can be avoided simply by not buying the taxed good or service. In this respect, it can be seen to be a form of tax avoidance. The arrangements of an individual are first so as to mitigate the liability to tax is tax avoidance. When provided that the taxpayer acts within the framework of the law, tax avoidance is legal. However, where the activity is within the letter of the law, but outside the spirit of the law, the distinction between avoidance and evasion may become blurred, as we said earlier on. On the other hand, where illegal means are applied to reduce taxes, then it constitutes tax evasion. Tax evasion is a crime punishable by severe monetary fines and imprisonment. But the qualitative difference between tax avoidance and evasion is in the eye of the beholder. Many aggressive tax plans involve major questions of judgment. Taxpayers eager to implement these plans run the risk that the GRA, as the Ghana Revenue Authority, will conclude that the plan crosses the line between a good faith effort to reduce tax and a willful attempt to defraud the government of Ghana. Business managers should always exercise caution and consult a tax professional before engaging in any transactions with profound tax consequences. If tax avoidance strategies are legal, are they ethical? In 1947, Federal Judge Leonard Hand answered this question in the following way. Over and over again, courts have said that there is nothing sinister in so arranging one's affairs to keep taxes as low as possible. Everybody does so, both the rich or poor, and all do right, for nobody knows or nobody owes any public duty more than the law demands. Taxes are enforced actions, not voluntary contributions. To demand more in the name of morals is mere cant. The spirited defense of the tax planning process makes the point that every person has the civic responsibility of paying the legally required tax and not a penny more. Business managers should be reassured that when they engage in effective tax planning, the entity variable which entity undertakes the transaction, to the time period variable during which tax year or years does the transaction occur. Then we have thirdly the jurisdiction or the location variable, in which jurisdiction or the geographical place does the transaction occur. Then we have the fourth point, the character or activity variable, as what is the tax character of the income from the transaction. We will focus on each variable in turn to ascertain why the variable matters and how it can be manipulated to change the tax outcome of the transaction. Let's get to understand the variables better. Since business managers should be reassured that when they engage in tax planning, they are bound to brace themselves with this. They are engaging in proper behavior from the perspective of their firm, their government, and society. Now, differences between tax evasion and tax avoidance can be in the meaning, in the concept, and which type of means used, and happen when, the type of act and consequences. In the meaning, we are saying that reducing tax liability by using illegal ways is known as tax evasion, while on the other hand, minimization of tax liability by taking such means which do not violate tax rules is tax avoidance. In terms of concept, in tax evasion, deliberate manipulations in accounts are made resulting in fraud. With tax avoidance, everything is cool. We are taking unfair advantage of the shortcomings in the tax laws is bound to arise. Then on the basis of which type of means used, when you use the tax avoidance, it's a justified means, and use of such means under the tax evasion is forbidden. Then tax avoidance must occur before the occurrence of tax liability, and tax evasion can always be done after tax liability arises. We have type of act where tax avoidance is legal but tax evasion is criminal. And the consequences: with tax evasion, you are bound to be slashed with a penalty or imprisonment. In tax avoidance, you can defer your tax liability. There's a deferment of tax liability. We move on to tax planning as a mechanism for tax avoidance. Now, the definition of tax planning goes like this. Tax planning is the structuring of transactions to reduce tax costs or increase tax savings in order to maximize the net present value of the transaction. So here you try to reduce your tax costs or increase tax savings in order to minimize the net present value of the transaction. Principles of tax planning. If the tax law applied uniformly to every commercial transaction by every entity in every time period, it would be neutral and therefore irrelevant in the business decision-making process. However, as we will observe over and over again, the income tax is not neutral with respect to business transactions. The tax system is replete with rules affecting only particular transactions, entities, or time periods. And in every case in which the law applies differently with respect to a certain city of business, profits, or loss, planning opportunity is born. The tax consequences of a business transaction depends on the interaction of 4 principles common to all transactions. These principles are discussed below. So the principle of the entity variable, the time period variable. Please drop a comment as to what you know so far about the principles we are all sharing. And please, you pause here so you subscribe. I indicated we have the entity variable, the time period variable, the jurisdiction variable, and what again? Add your own. The character activity variable. We'll try to explain all of this for your understanding. The entity variable. In Ghana, individuals and companies are the 2 primary entities that pay taxes on income generated by their business activities. Whilst trusts and estates are also taxable entities, they do not routinely engage in the active conduct of business or trade. Therefore, this test does not address the specialized rules governing the income taxation of trusts and estates. Business certainly can be conducted as partnership or sole proprietorship, but these organizational forms are not taxable as entities. They are not to be used to be taxed as an institution but as individuals. Income generated by a partnership or sole proprietorship is taxed to the partner or individual. Partnership or sole proprietor is taxed under first schedule using the graduated rates, the tax rates for individual and companies, and why not same for companies depending on other variables such as character variable or location. The tax rates may be different. For example, most companies pay tax at the rate of 25%. However, mining and petroleum companies pay tax at the rate of 35%. However, tax on individual income such as partners or sole proprietorship is progressive in nature from first schedule. Individual tax rates are progressive. Progressive meaning that given a cedi of business income, the tax liability depends on the marginal tax rate of that individual earning that cedi. This variable is especially important when entrepreneurs are starting a new venture and must decide which organizational form to adopt. The choice of organizational form determines whether the business income will be subject to the individual tax rates or the corporate tax rates. So I'll put something there for you to see how the taxpayer liability is kind of calculated. So if a taxpayer in a company or trust, that has to pay 25% of an amount, you will see it. Apart from the entity variable, we have the time period variable. So the entity variable, depending on the type of organization choice you have formed, you pay its respective rates. The time period variable has it that income taxes in most cases are imposed on an annual basis. The tax cost or savings with respect to a transaction depends on the year in which the transaction occurs. These costs and savings are a function of the firm's marginal tax rate. If that rate changes from one taxable year to the next, the firm's tax cost and savings fluctuate accordingly. A tax benefit available in a year may disappear in the next. For example, under Act 592 of 2000, companies had opportunity to carry forward an unutilized capital allowance to subsequent years, but this opportunity is not available to companies now. Refer to Section 14(3) of Act 896 of 2015. Conversely, a statutory restriction causing a tax problem this year may be lifted in the future. Managers must be aware of annual changes in the tax laws pertaining to their business operations. By controlling the timing of transactions, they may reduce the tax cost or increase the tax savings for their firm. Even if marginal tax rates and income tax laws were absolutely stable over time, the cash flows attributable to tax consequences of business transactions would still vary with time period during which the transaction occurs. So we have an example of a time variable with particulars referencing to personal income tax to see how time differences change the tax liability of a person's whose chargeable income was 35,000 for your perusal. This variation is attributable to time value of money. In present value terms, a cedi of tax paid in the current year costs more than a cedi of tax paid in the later years. Conversely, a cedi of tax saved this year is worth more than a cedi of tax saved in some future period. So as I indicated, let's see with a chargeable income of a firm which is 35,000, how the time variable works. We move on to the jurisdiction or the locational variable. The geographical location of a firm within a country may affect its income tax liability. In this case, the tax costs decrease and cash flows increase when income is generated in a jurisdiction with the low rates of tax. For example, in Ghana, Act 896 of 2015 provides locational incentive for manufacturing companies depending on the geographical area they are sited. Manufacturing companies located in regional capitals are granted tax rebates of 25%, whereas those cited elsewhere are granted tax rebates of 50%. Again, the incomes of young entrepreneurs from the business of manufacturing, information technology and communication, waste processing, tourism and creative arts, horticulture and medicinal plants are exempted from tax for the first 5 years of operation. Beyond these tax holidays period, they had to pay taxes under the following concessional rates depending on their location. So the young entrepreneurs, those located in Accra and Tema, will have to be charged at the rate of 15% as their tax rates. Then those in other regional capitals outside the 3 northern regions will be charged 12.5%. Outside other regional capitals, that's 10%. And the 3 northern regions will be at the rate of 5%. Firms can sometimes use these locational advantages to operate in foreign countries where the tax rates are low. Clearly, managers must be aware of the income laws of every locality in which their firms operate or plans to operate in the future. Managers should appreciate that they can often minimize the firm's total tax burden by conducting business activities in jurisdictions with favorable tax climates. Wow. In brief, with the locational variable, wherever you are, like that is also the same as the jurisdiction variable. Where your business is located determines the percentage of tax rate to be paid. We also have the character or the activity variable, which is the last of the variables that determines the tax consequences of business transaction. The tax character of any item of income is determined strictly by law. It is not intuitive and may bear no relationship to any financial or economic attributes of the income. Under this variable, the income tax liability of the business depends on the sources of the income. In Ghana, institutions that earn their income from agriculture, such as tree crops or cash crop farming, have tax holiday periods of 10 years and 5 years respectively, during which the company will be paying tax at the rate of 1% of their earnings. If the business is livestock rearing, for instance, livestock such as cattle have 10-year tax holiday, whilst those in poultry have tax holiday of 5 years, during which these tax holiday periods they will pay tax at a concessional rate of 1% of the cocoa farms from cocoa is tax exempt, while institutions in rural banking are having tax holidays of 10 years. And after the tax holiday period, they would pay at a rate of 8% of their income. Remember that the income of the cocoa farmer from cocoa is exempted from tax. Privately owned universities are exempt from tax if they plow back 100% of their profit after tax into the business. Also, in the case of young entrepreneurs operating in a priority sector such as manufacturing, information and communication technology, agro-processing, tourism and creative arts, horticulture and medicinal plants shall be exempt from tax for a period of 5 years. With this activity or character variable, the source of the income determines the tax liability. Now, what strategies can we develop as far as tax planning are concerned? We're developing tax planning strategies. Our analysis of the variables that determines the tax consequences of business transactions resulted in the following maxims. 1. Tax costs decrease and cash flows increase when income is generated by an entity subject to a low tax rate. Secondly, in present value terms, tax costs decrease and cash flows increase when the tax liability is preferred until a later taxable year. Thirdly, tax costs decrease and cash flows increase when income is generated in a jurisdiction or location with a low tax rate. And finally, tax rates or tax costs decrease and cash flows increase when income is taxed at a preferential rate because of its character. The planning strategies that firms use to reduce tax costs and enhance cash flows typically reflects at first one of these maximum principles. Many business strategies combine two or more of these variables working together to minimize taxes. Other strategies may adhere to one variable but violate another. In such case, however, managers must carefully assess the overall tax consequences to determine if the strategies improve the net present value of cash flows. So, other examples of activities that are variable: rural banking. The income of a person from a rural banking business is subject to tax at the rate of 1% for a period of 10 years of assessment commencing from the year in which the business is established. In the waste processing companies, the income of that company from a waste processing business is subject to a tax at the rate of 1% for a period of 7 years of assessment. The period specified commences from the year in which the business is commenced. We have residential premises. The income of a certified company from a low-cost housing business is subject to tax at the rate of 1% for a period of 5 years of assessment. The period specified commences from the year in which operations commenced, despite sections 8 and 9 of Act 896. In calculating the income of the individual from conducting an employment, business, or investment for a year of assessment, deduct mortgage interest incurred during the year. An individual may deduct mortgage interest in respect of only one residential premises during the lifetime of that individual. These are all showing as examples of activity variables. That's the character variable. We also have approved unit trust scheme and mutual fund. The income of an approved unit trust scheme or mutual fund is subject to tax at the rate of 1% for a period of 10 years of assessment. The period specified commences from the period in which the operations of the approved unit trust scheme or mutual fund commences and includes the year in which the basis period of the trust or scheme ends. The interest and dividends paid or credited to a holder or a member of an investment in an approved unit trust scheme or mutual fund is subject to tax at the rate of 1%. Also, there is venture capital financing company. The income of a qualifying venture capital financing company is subject to tax at the rate of 1% for a period of 10 years of assessment. The period specified commences from the year in which the company first qualifies. Loans incurred by a qualifying venture capital financing company may be carried forward for 5 years of assessment following the end of the period specified. These losses include losses incurred by a venture capital financing company on the disposal of an investment in a venture capital subsidiary company under Section 17 of the Venture Capital Trust Fund Act 2004 at 680 during the period of 10 years. Interest and dividends paid or credited to a person qualifying investments in the company are subject to tax at the rate of 1% for a period of 10 years. Well, let's consider this. Illustration. This is an illustration. Management of Kwame Enterprise Limited considers increasing its stated capital by transferring 600,000 Ghana cedis from income surplus in 2019 year of assessment in its bid to expand its business horizon in future. The management of the company intends to consult widely on the taxability, if any, on this line of action. Required, assess the tax implication of this funding arrangement by management of Kwame Enterprise Limited. So let's try to solve it. The management of Kwame Enterprise Limited's proposal to increase the stated capital will have to be given a legal effect. This arrangement therefore will require payment of stamp duty. The stamp duty, which is a direct tax, is calculated at the rate of 0.5% of the amount of stated capital. In this case, the amount of stamp duty is 0.5% of 600,000 Ghana cedis. Expressed on it, it is giving us 3,000 Ghana cedis. So therefore, management of Kwame Enterprise Limited shall pay an amount of 3,000 Ghana cedis as stamp duty to Ghana Revenue Authority through the Registrar General's Department before the proposed transaction will take legal effect. So we have to note this. Well, if you have more illustrations or examples, do drop it in the comments section. I hope you have enjoyed it. Like, share, comment, subscribe particularly, and let's all learn. Thanks for your time. I enjoyed this session too.